Hello and welcome to today's webcast entitled Building and Maintaining Wealth Through Strategic Planning and Tax Planning. My name is Nate and I'll be your event specialist today. If you should need technical assistance at any time during the meeting, please type your inquiry into the tech support box on the left-hand side of your screen and click on the send button. If you are disconnected from the webcast, you can log in again using the login instructions provided to you. If you cannot log back in with these instructions, please call support at 866-271-7592. We'd also like to take any questions that you might have for us today. To ask a question via the web, click the Ask a Question button, type in your question in the open area, and click on Ask Question to submit. It is now my pleasure to turn the webcast over to your first speaker, Russell Price, Executive Vice President of Private Bank by Nevada State Bank. Russell, the floor is yours.
Thank you, Nate. Good morning. One small housekeeping matter. What you'll see in front of you is we're going to have a couple, I believe 2 poll questions that will appear. We invite each and every one of you to give us a response back so we can help better serve you in the future. It gives us a little more data on who you are. As Nate introduced me, my name is Russell Price, Executive Vice President at Nevada State Bank. My areas of coverage are what I call our advisor divisions. Our advisory divisions include our private banking division, which serves the high net worth, our executive banking division, which serves high income, and then our wealth management division, which serves the needs, investment management needs, trust service needs of our clients. I'm very excited about today's webinar. We're going to have some interesting topics such as appreciation shifting, asset protection, utilization of trust, offshore planning. I think these are important topics in today's economy because, as we have learned, it's not always what you make, it's what you keep. I have 2 great guests with me today. First of those guests is Mr. Curt Anderson. Curt is a co-founder of Fair, Anderson, and Langerman. Curt has been a CPA since 1974 and part of the Nevada community since 1984. Also with us today, our second speaker will be Carl Rowe. Carl is with Clarity Advisors to Management. He's a founder of Clarity Advisors. He has been a career professional consultant since 1973. He holds many distinguished honors, such as the Top 50 Over 50 from the Las Vegas Press. Carl's been in the Las Vegas community since 1998. Gentlemen, I'll let you take it from here.
Thank you. Welcome. I'm Carl Rowe.
Curt Anderson.
And we are also joined, luckily I might add, by Megan McLean, Fair Anderson and Langerman's Director of Marketing, who will keep us from wandering too far afield. So if you hear another voice from time to time, it's Megan doing just that. Today we're going to talk about wealth, building it and keeping it. And we flashed up the goal so that you all can see it and read it at your own pace. But we want to help not only in the creation of wealth, but more important, retaining it, as much of it, at least as you can, through putting in place proper planning and tax strategies for your business, so that you ensure its continuing financial health and your own well-being. We have several issues that we want to talk about. Russell, I think, mentioned a few of them. Let me just go over them real quickly. We will, and keep in mind that our presentation necessarily is short, so some of these subjects we could devote a day to them, but we'll cover them very briefly. If you have questions, please ask. And of course, there are always times after the presentation that we can help you out.
Sukin, this is Megan. We are having a technical difficulty scrolling through these slides over here.
Okay, we can advance the slides.
We should be on 3, and it's just not moving forward. Are Are you able to move it to slide 3 on your end?
Yeah. Do we see overview?
Yeah, you see overview.
No, we see goal.
Well, that's the next one after. Okay.
Here we go. Hopefully we're...
All right. Let's run over these real fast. The topics include your business, maximizing its value, strategic succession planning, management development, implementing a planning process, and then into income shifting, appreciation shifting, asset protection, offshore planning, and utilization of trusts. And to get everyone into the proper frame of mind, this is an early Roman philosopher, and I think we all agree with that sentiment. We will assume that it is lawful profit, however. So, when we talk about building your business, specifically wealth and tax strategies, what we're really focusing on is your business. And if you're like the majority of independent business people in the country, you're likely in a small, probably family-owned business. And so it's in that context that we're making our presentation today. As a business person, you know that your business is your single biggest asset. You also should remember that it most likely is the biggest contributor to your retirement. Consequently, your best investment strategy is quite straightforward. It's to maximize the value of your business. And probably the best way to look at maximizing your business's value is to consider it in the context of what you would need to do if you were to sell it. So here are some basics to ensure that your business is in the most valuable position. First of all, you need to be able to show good financial strength, good financials. Your financial statements need to be clear and understandable. Have you calculated the EBITDA? That's the earnings before interest, tax, depreciation, and amortization. And that, along with business ratios, are what a potential buyer will look at to determine whether, to him or her, your business has value. Also, can you demonstrate that you're current on your taxes? Good businesses are always current on their taxes. You don't want any questions coming up about the financial stability of your business. And have you had a valuation done of your business, a professional valuation? So those are some of the things that you want to be able to show if you were to sell your business to a potential buyer. Next, how's your bench strength? What does your executive level suite look like? That includes you as the owner and your C-level or your top executives. Do they have the proper credentials? Do they have the proper experience to be able to show that they are an asset? And then you move to your second level managers. Do they also have the experience, and do they have the skills necessary to move up? In other words, are they marketable? Do they have marketable skills and credentials that would be desirable to someone who's buying the business? And are they ready to move up? So, how's your market, and what do you know about your market? For example, how do you get industry information? How do you understand your industry? What's important to look at in your industry? Do you know what your market share is? And what do you know about your competition? How do you get that information?
I wonder if you could call him on the cell and tell him when to flip. Maybe he can flip these.
Finally, your customers. What kind of customer relations do you have? Have you elicited a good deal of goodwill from your customers? Are you and how do you know, for example? I mean, what kind of feedback do you get from your customers? Have you ever done a customer survey? In other words, if you were going to tout the value of your business, you want to be able to speak to your relationships with your customers. If you decided to stay, or well, I'll put it this way, another thing you need to consider is, are you willing to stay involved? If you were to sell your business, would you be willing to stay involved for a time in order to help the new owners get along? If not actively involved in the business on a day-to-day basis, would you be willing to serve as a consultant? As most of you know, frequently when you sell a business, they will ask the founder, the principal executives to stay on, maybe in a consulting role. You have to be able to determine, because remember, you are, especially if you are a top executive or the founder of the business, you are a large part of what makes up the value of the business. And so you need to be able to be prepared to know what is your business worth if you're not there, and what kind of continuing involvement would you like to have or should you have. And then finally, I guess you've probably got some banknotes out there, and you may be asked to continue to carry some of that obligation. Again, keeping in mind that we're looking at your retirement, perhaps, the question is, do you retire fully, or do you continue to stay involved to ensure that your retirement will be more pleasant? So, then finally, I guess, what planning has your business done? Are there any changes in the offing? Have you established any goals for the business? And what kinds of planning have you done? Planning is the lifeblood of any business. You've got to have some idea of where you're going, and there are many, many different types of planning. For example, operational planning looks at how you're going to maintain efficiency and profitability in the products you move or the services you offer. Marketing maps out your campaign for exploiting the market. What niches will you target, and what strategies will you use? And then advertising sets out the messages you want to convey to whom and in what form. And strategic planning pulls it all together in order that your business can move ahead in a concerted way. Unfortunately, I'm sorry, Megan?
We are still having technical difficulties. Sukin, we're going to need you guys to advance these slides for us. They are not advancing on our end.
Okay. Do you see? We should see relations, goodwill, and feedback on the screen.
Okay, we'll want to move. We'll want to move ahead to planning.
One more page. There we go.
All right.
Okay.
Apparently the gerbils that run this system weren't fed this morning. This doesn't seem to be working for anybody.
Well, we can talk through these things, but it really does help to have a little graphic so that you can fix it in your mind. But let me reiterate, we certainly are available and willing to respond to questions, and either as a result of this webinar or even afterwards.
And we're going to send these slides out to anyone who wants them, I presume, right?
Yeah. Do you see future changes in goals?
Nope. We see customers. Heading of customers.
All right. So we should be on the planning slide.
Yes.
And then I'm ready to transition to the next, which says more planning.
Okay.
Okay?
Go ahead.
All right. In any event, unfortunately, with regard to planning, much of the planning that's done, especially by small businesses, tends to be the seat of the pants variety, and that doesn't bode well for the business or its value, which brings us to the most important kind of planning that a business can do, and that's planning for succession. Next slide. Succession planning can be defined as the deliberate actions taken by today's ownership of a firm to ensure sound, competent future leadership that will perpetuate the firm. So if we go back to our original premise that number one, your single biggest asset likely is your business, and two, you're counting on that business to fund a large part of your retirement, it's not hard to see why planning for who will succeed you and other executives in your firm is crucial. Next slide. How does one actually do succession planning? Well, first, note that planning for succession does not focus solely on replacing yourself if you're the owner or the founder. It means taking into account the whole of your company's leadership, bench strength, if you will. One of the worst things that can happen to a firm is to suddenly lose a key executive without having someone able to step in. Consequently, succession planning isn't confined simply to considering how to fill a vacancy, but more important, how to develop the skills and abilities in your lower level managers to be able to assume those leadership positions if and as they become vacant. So we call it both management development and succession planning. So as we walk through the succession planning process, keep in mind that it's every bit as relevant to your whole management structure as it is to the owner. Next slide. We've put together the steps in a typical succession plan. They'll vary, of course, according, to the type of business and other variables, but these will give you some idea of what's involved when you decide to undertake the process. So, do we have a slide?
Yep, 10 steps.
Thank you. Okay. I was reading off of our slides, and we don't have them. First of all, you need to review your organization's vision, mission, and core values. Some of you probably haven't done that in a formalized way, but you do need to be able to review those in order to convey what it is you want for the future. And then you need to consider the issues that are going to impact the organization's future. Are there things in the market that are going to affect the company, things that are down the road that may have an impact on your profitability? You need to develop a short-term replacement strategy. If one of your chief or top executives or you get hit by a truck, what are you going to do immediately to fill in and continue the business? The next thing you need to do is put in place an analytical process to determine the requirements for each of your executive positions. What are the skills, the abilities, the traits required for each of the key positions in your company. And then you identify the potential internal successor candidates for those positions, yours as the founder as well as your C-level executives. And then you put those potential successors through an assessment process to determine what skills do they have, which ones, more important, do they not have, and need to develop in order to ascend. And with that information, you formulate individual development plans for each of your internal candidates over a period of time. Now, we're talking, a 2 to 3 year process, so this isn't something you do overnight. The next thing is the long process of simply developing a recruitment strategy for outside candidates, because it's likely that you're not going to find the perfect candidates internally. So you've got to have a strategy for outside candidates. Once you have that in place, and once you have your individual development plans in place for your top internal candidates, then you begin to evaluate progress until you get to the point where you either need to fill a position, yours or one of your senior executives, or something else happens, but you finally do a selection and vest final authority. And that's really, in a nutshell, how you do succession planning. Now, let me put in a plug for that's self-interested. You should have an outside expert help you, because this is not something that's easily done internally, and it does tend to detract from the ongoing work if you're trying to do it yourself. So that's my pitch, and I'm sticking to it. And and I think I'm going to now turn it over to my colleague, Curt Anderson, and he can go into some of the more arcane things that you can do to maintain your wealth and make sure your business stays healthy.
Yeah, I think our experience over the years is that our client base is classically entrepreneurial, family-owned businesses that grow to pretty significant size. And what I want to kind of give an overview of this before we get into the specific slides. What happens frequently is you build up a nice asset value in your business, and if you're fortunate, you have other assets that you've invested in that have diversified your portfolio, so to speak, that all your eggs aren't in the one basket of your company. You've got other properties and things of that sort that are valuable as well, building an asset base and an income stream independent of your company, which was a great plan until about 2009. And at this point, a lot of us have found that those assets off to the side are not generating the income we hoped, nor the value that we hoped. But I think we all hope that that's going to change in the future. So from an overview standpoint, what happens a lot of times is that people start worrying about liability issues on an unfocused basis, or they think they're paying too much taxes, or they're worried about the state taxes, and they'll initiate a process of, what can I do to save taxes? What can I do to save estate taxes and things of that sort? And there's a ton of simple and sophisticated processes you can use to accomplish these goals. I mean, you can sit down and start talking with me or an estate tax attorney and start going through these options, and you can talk for hours and hours and hours. I mean, it can go on and on and on. The clear issue to start with, though, before you even go down the technical path, is to say, what am I trying to do? What's the purpose of this? Let me give you a couple of examples. We've got a long-term client, owns a number of businesses, has in fact diversified into other types of assets and income, which actually are still valuable and making income, which is kind of nice. And net worth, notwithstanding all our efforts of transfers that we've done in the past and whatever, his net worth continues to grow and grow and grow. So we recently had a meeting with he and his financial advisors and said, there's some opportunities here with some things that you're getting into that we could transfer these off to second and third generations, and they're nice income-producing properties and businesses, and maybe we ought to take a look at that. And my client said, I've transferred a lot to these guys already. They got a lot of money coming in anyhow. And I'm not done. I think there's a lot of opportunity in this marketplace right now, and cash is king, and I just kind of feel like I want to be able to take advantage of those things. And my comment to him was, you know, it's your erector set. This is what you used to build your financial assets. This is like a kid playing with an erector set on a very sophisticated basis, so to speak. He doesn't want to give up his erector set. He really is still enjoying what he's doing. He's 65, 66 years old, enjoying what he's doing, lots of opportunities out there, and that's what he wants to do. So he's made the decision from an income tax and an estate tax standpoint that he's kind of where he wants to be right now. We'll keep looking at opportunities, but he wants to keep playing with that erector set. So that's an example of, you know, what's this all about? What's our purpose here? And do these technical things serve our purpose? Second example is of an individual client that we've had that sold a significant portion of his business a few years ago for some pretty serious money. And he was at that time concerned about some potential legal liability from an investment he had been involved in. So he got very concerned about that, and in that process formed with a very qualified estate tax firm here in town, formed a bunch of entities, family partnerships, trusts, some offshore entities, and a number of different things in order to try and create an asset protection plan because of this contingent legal liability that he was uncertain, you know, as to the dollar amount. So his financial structure looks like a roadmap of rural Bulgaria. It's pretty complicated, and he really doesn't own much in his own name. It's really owned by various trusts and things of that sort. So in the last year, the legal issue that he was concerned about has kind of dissipated. It's gone. Fundamentally, it's gone. And so now he's sitting there going, I don't know whether I want all this anymore or not. And he's thinking that he wants to unwind some portions of this because this particular client has some of that erector set mentality too. He's only in his late 40s, early 50s, give or take. So, I mean, he's not done building. He's still out doing things. So he found that excessive approach didn't fit him. So, and the estate tax attorney was really responding to this perceived need. So I'm not trying to say that the lawyer sold him a bill of goods. That's not the case. It was his paranoia about that liability that drove it. But it's an example of how sometimes you can inadvertently overreact and overcomplicate and later wish you hadn't done some of those things. And we're in the process of unwinding the things that can be unwound without too much difficulty. So in the concept of income shifting, appreciation shifting, asset protection, offshore planning, some of the things we'll be talking about here in a second, the overview simplistically is this. There's no free lunch. There are ways to move assets to shift income. There are ways to move assets to shift value, growth, and appreciation. There are ways to retain some element of control through voting rights and things of that sort. But if you think about it, fundamentally, from an income tax standpoint and an estate tax standpoint, the concept's simple. If you don't want to be taxed on the income, don't own the income. If you don't want to be taxed on the asset at your death, don't own the asset. So the various complicated structures that we come up with to accomplish this typically involve not owning the asset, maybe controlling it in some indirect ways or allowable ways, but you have to psychologically say it's not mine anymore. I can't control it. I may create income and not distribute it to the beneficiaries or whatever, but I can't take the income myself. I can't take the cash from the income that was taxed to my kids or grandkids and use it myself. I can't take the asset that I transferred to my kids or grandkids and continue to use it myself on an unrestricted basis. If you have too many of these strings, whether they're technical strings or practical strings, that you've just been doing what you're doing, using it as like a personal piggy bank, you're not going to get the benefit of the transfer that you were looking for. You're not going to get the income tax shifting benefit. You're not going to get the asset shifting benefit that you're looking for. So simplistically, if you want to achieve this, you have to look at it like you're giving it up and it's gone. And that's daunting to think about that. Most people find that a little difficult to deal with. So that's why we typically edge our way into this with baby steps, so to speak, and look at things that can make some sense, put our toe in the water, test it, see if we're happy with it, and if we are, then we keep doing more and more things. From the standpoint of income shifting, I don't know can we move back one to the income shifting slide? Yeah, there's various ways to do income shiftings. Family limited partnerships, limited liability companies, trusts. There's a number of different entities types out there. And so as an example, if you're trying to shift income from the standpoint that there's an income-producing property that you own, it's an office building that's generating cash flow, and you want to shift that income over to other members of the family, you might create a family limited partnership. You might use a limited liability company and transfer the ownership into that particular vehicle. And in those situations, you can typically retain voting control, but you would have done a transfer by some means, gift, sale, or what have you, that shifts the income from that property over to someone other than yourself. The trap that you could run into sometimes is, particularly if you're in the highest bracket, 35% marginal bracket, and you're trying to move income over to a family member at a lower bracket, the IRS, the Congress, keeps messing around with this concept. It used to be that there were certain specific rules relating to unearned income that you're transferring earned by minor children. And those rules only were in play until the age of 14. So as an example, if you put them in a project that generated rent income or interest income or dividends, things of that sort, up to the age of 14, it used to be that you could not obtain the benefit of your child's lower tax bracket. They would have to pay their tax at the same bracket that you're in. So the transfer wasn't very effective for certain kinds of income to young children, to dependents, your children, grandchildren. They subsequently moved those rules up to, in general, be effective to the age of 19 now, and if your child is a full-time student, to the age of 24. So it's much more difficult to move what we would call unearned passive-type income to lower income brackets with your children because of these unearned income rules that have been expanded significantly in the last few years. But again, sometimes it still works, particularly if you're trying to combine an income shifting strategy with an asset shifting strategy. If your real goal is to transfer the asset that's generating the income, then you may not be concerned that the income isn't really saving any taxes because you're achieving your primary goal of transferring the value of the asset itself down the road. So it's one of those caveats, things to be concerned about. So in appreciation shifting, the next slide, there we go. There's a number of methods of transferring assets to obtain the goal of taking ownership of, or portions of ownership of assets out of your estate and putting those into the next generation. Typically, we have control issues in these situations. Again, it's back to the erector set concept. I want to have some sort of way to make sure these assets aren't misused, aren't abused. So we try to find vehicles like limited liability companies, again, in certain cases trusts, to transfer those assets. And there's valuation issues that come into play. Right now, in this market, as we all know, everything's worth a lot less than it's ever going to be worth in the future, we hope. So low valuations make transfer techniques right now pretty attractive. If you've got property that you really believe will be more valuable in the future, if you want to transfer that either by gift or by a specific structured sale, the tax consequences, both either income tax or gift tax consequences of those transfers, are significantly lower right now because of the low market valuations of about everything in the marketplace other than cash. So we use a number of techniques. We use gifts, if appropriate. We use sales, if appropriate. One of the nice things right now is because the interest rates are so low, the applicable federal rate, AFR, that applies to sales transactions so that you have to charge a certain minimum interest, is very, very low right now. So as an example, if you were to sell something to a related family trust or limited liability company and wanted to charge interest, and the loan was like a 3-year loan, you would actually charge 0.169% interest on it, which is pretty cheap. If you have a loan, if that loan has like a 9-year term on it, it would be 2.91%. You can't borrow on a car at these rates right now. And the rates are even a little bit lower in the month of November. These interest rates change on a monthly basis. So there's a number of sales techniques that we use, and I mean, you'll hear, if you sit down with a lawyer and me and you start talking about his, you'll start hearing acronyms like GRIT, GRAT, GRUTS, CRUTS, all sorts of things. You know, it sounds like you just walked into a doctor's office, but there's a number of sophisticated techniques out there that in some cases allow you to take an asset, transfer it over for an income stream during your lifetime, and then the asset is totally out of your estate at the time of your death. So you enjoy the benefit of the income, and there is no asset to be valued in your estate. And we do that through things like this GRAT that you see here, GRAT. Self-canceling notes can be another method of doing this. There's pros and cons to all these techniques, and so it's not one size fits all. So just because the guy down the street used a self-canceling note to move an asset out of his estate, that might not work for you. So this is where a good estate planning attorney, a good CPA, really helps you to fix. If in fact you've gone through the "what am I trying to achieve here" process, if you know that this fits you, if you've figured out exactly what you're trying to achieve, then we find the method that works for you. We want to fit the method to what you want. Too often people go in and say, I don't know what I want to do, what are my options? You hear the options and you pick the options and you don't know whether or not they're really achieving your purpose. You just know it's a way to do it. So we don't want to put the cart before the horse, so to speak, here. Now on asset protection, this area has become a wildfire area in the last few years, particularly with the advent of the Nevada Asset Protection Trust, and also with the change a while back where it used to be when you put assets into an asset protection trust in Nevada, you had to let those transfers cure for a couple of years before they were presumed to be effective. The legislation was changed to allow the transfers to be purportedly effective at the moment you transfer the asset into the asset protection trust. And as every lawyer will tell you, this hasn't been tested yet. So there's some issues there. But the idea behind asset protection, as in the case of my client that I mentioned, is obviously you're trying to take your assets and protect them from legal liability. Now, the question that becomes really important here is, what kind of liability are we talking about? If you're talking about general civil liability, trip and fall, that personal liability types things, liability insurance is out there in significant sums to protect you from that kind of thing. So we typically urge clients, before you start transferring assets, and remembering particularly when you get into asset protection, the concept of you got to let it go, you don't want to own it, is even more important, because you're not just talking tax issues, you're talking the legal issues if you end up in court and somebody's trying to break the asset protection trust and get at that asset. So the mindset of I don't own this anymore is really important when you're talking about asset protection. So if you're trying to protect from a liability that you're afraid you're going to run somebody over on the way home from work, you might want to think more about getting the bigger umbrella policy than doing asset protection. There's a lot of undefined, unfocused activity in this area because people think, well, I can be sued. Well, you can be sued for walking across the street if you get right down to it. Now, the next one's really important to entrepreneurial business owners. And I just had a conversation with a fellow who came in and talked with me. He's not a client, but he moved all his assets into asset protection trusts. And he's kind of like my other client. It kind of looks like the roadmap of Bulgaria there. He has nothing in his own name. And if he wants to borrow from a bank, he's got a problem because he can't guarantee. He doesn't own anything. The only way he can guarantee is if the companies and the trusts that he formed to protect these various assets will engage in a guarantee. And the trusts are set up in a way that it says that it's not in the trust's best interest to guarantee anything. So you've got a question as to whether the trustee can even legally bind himself with a guarantee to a bank. And the reality in our world here in Las Vegas has been, is, and always will be, if you want to borrow significant money from a bank, you're going to have to put your personal guarantee on it. They're not going to just lend you the money because they like the color of your eyes. And if there's no assets that they can see that you can use at your discretion to satisfy a guarantee, they're going to have a problem loaning you money. And this is exactly what would happen to this guy. So now we're going back to those asset protection trusts, and we're trying to figure out how do we modify those things so that they can execute a guarantee? Because he needs to have about $1.5 million credit line with a bank, and nobody's going to loan him that kind of money without some sort of a guarantee. Ergo, that's the next slide, the next bullet that says protect selected assets. Sometimes what happens is, if you in fact really do have a liability issue that you're concerned about, you may have to selectively say, okay, I need to protect certain assets from that legal liability that I cannot insure against. But yet at the same time, I got to figure out how I can leave something so that I can give a bank a guarantee so that I can borrow the money I need necessary to run my business and keep building the value of that business, particularly if you're thinking about succession planning like in Carl's case. So there's a lot of important issues here that frequently get glossed over. One thing that you see is offshore planning. Seems like it's a part of everybody's discussion of asset protection. And there's a number of different things here that you just have to really think through. It's not a cheap process to do this. You've got the maintenance cost. The individual, as I mentioned, who has that very sophisticated structure, he's got an offshore trust, Cook Island Trust, that has significant bank accounts in New Zealand. So I guess if he wants to fly over there to write a check, I guess that's a good thing. But otherwise, he's got a lot of his assets outside the country with some limitations on his ability to get to them. Some people believe that just because the asset is domiciled outside the states, that there's no U.S. tax on it. And that doesn't work that way. Our country is one of the few countries. Our tax law started in 1913. Europeans have had tax laws since forever. We are one of the few countries that taxes citizens on worldwide income. It doesn't matter where our citizens are resident, typically. You're going to pay tax in the United States on your income if you're a citizen in the United States. And it doesn't matter if it was earned in Switzerland or Poughkeepsie. It's going to be taxed. There are more and more concerns about people dropping money into offshore accounts and not disclosing them, not paying tax on them, and to the detriment of the IRS and creditors. So I think we've all read over the last few years of the situation with UBS where they disgorged their list of U.S. citizens that had offshore accounts. On your income tax return, there is a question that says, have you got an offshore account? Most people don't even know that it's there. We had a client that was referred to us a couple of years ago who doesn't, if he's in the United States 10 days a year, it's a lot. He lives in Hong Kong, Thailand, and what have you. His tax return prepared by his prior accountant never addressed the foreign bank account question. In fact, when I brought it up to him, he emailed me, because he wasn't here, and he says, how long has that question been on tax returns? And it's been there for like 30 years, I think. So this is a real high visibility area right now, and if you do have offshore accounts that exceed certain dollar amounts, and that offshore account definition includes accounts you have signature authority over, even if it's not your money, you've got additional filings that you have to make, separate and distinct from your income tax return. And if you miss them, the penalties right now are significant. We had a guy who came in, and he coincidentally had an account in New Zealand that he had set up years ago when he was in the Navy. And he just left it there and let it grow. It's kind of like, out of sight, out of mind, I'll just let it grow. Well, he didn't understand all these rules, and so we're helping him through the negotiation of the exemption process. But if he can't get through the exemption process, when he files these returns, he will owe a penalty. He's got like a $30,000 account over there, if it's that much. His penalty is something over $20,000. So this is serious. They're not kidding around. Sometimes we think that we ought to just stop being a U.S. citizen and become a citizen of Canada or Venezuela or someplace. People don't realize that if you want to do that, there's an outbound transfer toll tax that applies. And clearly nobody wants to it's very seldom that somebody wants to stop being a U.S. citizen for a lot of practical reasons these days. But yet, we have a client who is a British national with dual citizenship that is, in fact, thinking of dropping her U.S. citizenship. So she's subject to this outbound transfer rule that fundamentally says if the assets are worth more than their cost at the time you go out of the country, we want a tax on that. We want that appreciation taxed. And a lot of people don't realize that. So offshore planning is very sophisticated. It's just not the idea of setting up a bank account in Mazatlan for your vacations, and who cares? It's important. So the last thing that I really try to urge clients to think about is lawyers have a propensity for using trusts for a lot of actually very good reasons. But LLCs are starting to be very viable methods of transferring income and or assets too. Typically you use trusts because you want continuity of life. You like to have trustees independent trustees that can take care of things and whatever. The difficulty is that if that trust is accumulating income, the tax rate rises precipitously on income. As you can see here, that trust hits 35% at $11,000 of taxable income. That gets pretty confiscatory when you figure that 35% doesn't hit individuals until they're over $300,000 of income. So we really are very careful about just arbitrarily saying, oh yeah, let's put it into a trust, because if it's going to be accumulating, we might be better off with an LLC instead. So just a cautionary note, because a lot of the estate planning attorneys are not really income tax guys. They profess that. They don't want to be income tax guys or women. They want to be estate tax people. So these are the practical cautionary things that we talk with our clients about when somebody comes in and says, I think I got too many assets, I got to figure out what to do about it. This drill is what we go through to start figuring out what to do. So hopefully that's clear as mud. I'm done.
Okay, let's, if you guys don't mind, I have a few questions that we can go through.
Sure.
The first question, and the participant didn't elaborate on this, but how safe are 401ks? So let's take this in two parts if we can. First part, what is what part of it, is there a dollar amount that 401ks are protected against creditors? Would be the first part, and the second part, just the any other information from a tax viewpoint or on 401ks, in any changes in law that might be changing that you're hearing come out of Washington?
No, there's not really much going on with 401ks from the standpoint of tax issues. The amount available for deferral, the amount you can contribute is going up next year by a few $100, things of that sort. From a safety standpoint, I guess there really are two issues. One is the safety of your investment itself, and of course that really gets back to who's the investment advisor for your 401k plan. Typically the employers that set these up are going to have the money administrated by some sort of a manager. It might be a bank trust department. It might be some sort of a brokerage house. They'll use a qualified investment professional to invest the money, and in some cases give their employees input into how their money is invested if they've got particular things that they want to do. From a safety standpoint, going back to that liability issue, one of the things that you run into from a legal liability and bankruptcy standpoint is that assets in a company plan are exempted from certain legal liability type they have a certain legal liability protection in bankruptcy and other litigation suits, where an IRA, as an example, doesn't have the same protection. We had a client who had an IRA with about $3 million in it, and it was subject to claims of creditors, so we created a company and created a 401k plan, and he rolled his IRA over into the 401k plan to protect from some liability that he was concerned about. So if that's the meaning of safe, that's a couple of thoughts.
Thank you very much. Next question, what is being perceived as a more aggressive future in tax collection? Are there any types of strategies that you would recommend avoid at this point in time?
Well, I'll tell you, here's what's happening. We have a lot of people
they're asking about.
I'm sorry?
Are there any gray areas that they're asking about, it sounds like?
Well, no. Here's the deal. I mean, First of all, a lot of people are running into the problem that they owe taxes and they don't have any cash. I think that sounds like maybe that's where the question's going from a collection standpoint. So there's a number of things that you don't want to do if you're in that situation. First of all, you want to file a tax return. You do not want to not file a tax return. Even if you don't have the money, file the tax return. There are serious penalties of 25 up to 25% of the tax for not filing a return. So as an example, if you owe $100,000 and you don't file the return, you start off with a $25,000 penalty after 5 months. If you file the return and don't pay, you start off with a 0.5% per month interest charge effectively. So there's a big difference there. And you certainly don't want to run the risk of civil or criminal fraud if you don't file that return forever. Secondly, let's say that you do file the return and you know you can't pay it. There's a couple of things you can do. You can there is a sort of an automatic installment pay plan that if you attach it to the return and say, look, I can pay this, but I need 12 months to do it, and I can pay it in 12 monthly installments, you can get effectively a pre-approved installment pay plan. Now, for most people, that doesn't work real well because if you don't have the money now, you're not going to have it next month. So what we urge people is file a return. From a collection standpoint, do not ignore those notices you get from the IRS. They don't go away, and the more you ignore them, the more upset they get and the more aggressive they get. If you think about it like obtaining credit, because effectively that's what you're doing. You're asking the government to give you credit for to pay the tax. You don't want to tick the guy off that you're asking for credit. So responding and staying up with the information they're requesting, giving it to them in an honest manner to document what you feel you really can pay is the way to do it. If you deal with them professionally, you've got a lot better chance of getting to a good result. If that process isn't working, then you need to bring a qualified professional in, whether it's a lawyer or a CPA, but somebody who's conversant with the IRS collection rules and things, because they will tend to run a little roughshod on you if they can get away with it, and sometimes they're not really statutorily allowed to do some of the things they tell you they can do. So if you can't get to a reasonable result on your own, you may have to find some help. But don't ignore them. Do not do that.
Curt, I assume the answer here is yes, but the question popped up, do you guys provide actual tax planning?
Yeah, that's what we do. Tax returns a byproduct because the tax return ought to just be showing that you achieved your plan.
Very good, interesting question here. It sounds like someone that is possibly looking at selling, staging their business for a sale. Would you gentlemen recommend audited financials on a business that is about to go for sale, and how many years going back would a buyer want to see audited financials for?
I think audited financials always are more trustworthy and are seen more as goodwill. What do you think?
Well, I think having the most important thing typically is credible financials. Frequently what we do is, if we think that we're positioning ourselves for that, we might do a couple of things. It depends on whether there's a current need for a financial statement for bank lending, bonding purposes, things of that sort. So as an example, if we've got to do there's three levels of financial statements: compiled financials, reviewed financials, and audited financials. So if you're trying to position yourself in line with what Carl was talking about, and if you think that, depends on who you think your buyer is going to be, possibly, what you might want to do is, first of all, we make sure that obviously your financials are as rock solid and understandable as possible. It may be that your bank requires either a compiled financial statement or a reviewed financial statement for their file to do your credit lines and other loans anyway. So if we think that it's possible that down the road somebody might want to have an audit because they may feel more comfortable with an audit, sometimes what we do is we do the compiled financial or we do the reviewed financial. We do additional steps that we otherwise wouldn't do that would be part of an audit process, because some audit process steps really need to be done contemporaneously, not 3 years in arrears. So sometimes we'll say, look, spend a little bit of money now, we'll do these audit procedures so that if, in fact, you need to take your review and upgrade it to an audit, we can go back and upgrade those to an audit on a retroactive basis if, in fact, that's what you need. But if you don't need it, you've got the reviews and you haven't laid out the money for the audits. So it's very judgmental. In all honesty, I've done a lot of merger and acquisition work over the last 40 years. And I really don't see where audits are required. Typically, if a company's audited, it's because it needs to be audited for other reasons, and the buyer just says, oh, okay, fine, you got audits. So it's not as frequent as you might think.
Okay. One last question, and this one's interesting. I don't know how deep you guys will want to get into it, but we'll keep it short just because of time. If a individual is actually leaving, denouncing their citizenship, how does the U.S. government end up collecting taxes? What is that process they go through, especially if someone is already gone?
Well, if you're trying to renounce your citizenship, you got to formally renounce your citizenship. It's just not like you go to Canada and say goodbye. You have legal processes you have to go through to actually accomplish that. And in that process, they have, as you would expect, they have mechanisms to say, okay, have you filed these various returns to calculate any toll tax that may be due, and have you in fact done that? So, bureaucracy always wins.
Okay, very good. Well, I appreciate you gentlemen being here today. One last final housekeeping item. Please join us on December 8th. We will have guest speaker Tyler Garnes, who will be discussing the Strategic Business Blueprint, the key to higher conversions, growing sales, and saving time. So today I think we talked really about the bottom line, what you can end up, some strategies to keep the wealth and the income you create. And I think next week we're going to kind of talk about that top line. How do you grow sales and revenue in this type of environment? I appreciate everyone being here. If you have any questions, please feel free to send an email. You can also find us at Nevada State Bank, nsbank.com. Thank you so much.
Ladies and gentlemen, that does conclude our meeting for today. Thank you for your participation. You may now disconnect.